So just for the online audience, I'll repeat that my name is Jaideep Oberoi. Thank you for being here online as well. And now the session we are going to host is called Voices of Tomorrow, and the idea behind it is it's part of the capacity building work of the AXA chair, which funds partly the Center for Global Finance at SOAS. And obviously, it's a very important sort of role for any academic institution, any conference. And we're trying to experiment with this format, really, which is to have young scholars in terms of their academic age participating, sort of talking up from their perspective. And the idea is to have a conversation. So I'll invite you to sort of pitch in with your inputs, but mainly we want to learn the insights about the scholars and from them as well. So hopefully that's what they'll do. They'll present for about 10 minutes each at first. And then I'll ask them a couple of questions. We'll get a conversation going. And if you can add your valuable insights, that'll be really helpful. Okay, and so we'll see how the session goes, because we don't have a set format beyond that. Okay, so let me just name or introduce the scholars, our speakers today who are sitting on the panel, and then we'll I'll invite each of them in turn to come and speak for 10 minutes. Okay, so the first person who's going to speak is from your perspective, the second from the right is Raphael Kasonde. He's from the Bank of Zambia and the University of Lincoln. Then we have Catherine, who's right next to me, Catherine Tuhirirwe, who's from SOAS, and now an academic as well in a new position. And we have subsequently it'll be Chaofan, who's from Xi'an, Jiaotong-Liverpool University, and then Tianyi, who's from Oxford, and now living in Boston, I think. Yeah. So okay. So now we've got a very interesting profile also of the candidates. So I'll expand on that in a couple of minutes, but let's start with Raphael presenting what he's working on these days.
Thank you.
As you wish.
Good afternoon. Yeah, thank you. Afternoon. Yeah, thank you, Professor Bov, the chair, for the opportunity to be part of the distinguished panel, and for the chair of the session, Dr. Oberoi, and the rest of the colleagues. And Professor Murindo, of course, is the one who sort of introduced me to SOAS, and I've never looked back. So I'm talking about, Basel reforms and so on, which is sort of off the topic. The theme is about China and Africa. So to try and be as relevant as possible to the theme, I came with my flag. So Zambia celebrates 60 years of independence from the British rule on 24th of October, so in a month's time. And we are also celebrating 50 years of partnership with the People's Republic of China. So I think my topic now is relevant to the theme. Yeah. So I want to talk about capital requirements. So beyond Basel III. So, and I'll explain shortly. So I want to look at, I'm trying to look at the impact of significantly increasing the minimum capital requirements on bank risk and also on overall liquidity creation. I use a quasi-experimental approach. Okay. So in terms of the motivation, why talk about very high capital requirements? Yeah, and maybe to start with capital, a bank is a company and it requires capital. But in terms of banks, capital plays a much more deeper role. So in terms of capacity to absorb risk, given the business profile of banks. So I was motivated in terms of both theory and also empirical evidence, and the ongoing debate following Basel III, when Basel III was issued in December 2010. There have been some critics, academics and policymakers, that suggesting that the reforms have not gone very far in terms of trying to improve the resilience of banks and other financial institutions to shocks like the global financial crisis of 2007 and 2009. And of course, if you look at the most recent regional banking crisis in the US in 2023 and part of Europe, with the failure of Credit Suisse, which was a significant institution and Basel III compliant. So maybe the critics have been, right in that sense. So, the objective, we want to assess, the dual effects of a significant increase in capital requirements. I'm interested in the leverage ratio because for a country like Zambia, which is in sub-Saharan Africa, which is sort of vulnerable, to shocks because it's a commodity exporter. So risk-based capital requirements are weakened due to dollarization and also risk averseness. So there's very little of lending. So as a result, in terms of the risk-based, the requirements would be far much lower compared to the size of the balance sheet. So, and hence my focus is on the leverage ratio. So we want to address the gap because a leverage ratio is a flat capital requirement, so which theory predicts that it will increase risk. And like I said, there's also a lot of empirical evidence in that regard. So in terms of the data, quickly, I use the Bank of Zambia 2012 new capital adequacy. So, and I found an opportunity to use a quasi-natural experiment with a difference in differences identification strategy. So what happens in 2012, the Bank of Zambia came up with minimum capital requirements, which were far much higher compared to what it was. But then they went ahead and set different requirements for foreign-owned banks and locally owned banks without regard to size or risk profile. And that provides a lab environment to perform a diff in diff. Okay. So in terms of the model, later on in the conversation, I'll be able to come back. So I use just a standard canonical difference in difference model with fixed effects, two-way fixed effects. So the NCF bank, in this case, it's a dummy for a foreign-owned bank. So it equals 1 if a bank is a foreign-owned bank and was subject to high capital requirements, so which were 5 times higher than for the locally owned banks. And then the post is a binary, which equals 1 for a post policy period, which is between February 2012 to February 2019, and then the fixed effects. Then the interaction term, that's the DID, which captures the policy effect. So I'll quickly just summarize in terms of the results. The objective was to look at what the impact would be in terms of the risk and also in terms of liquidity creation, which is a primary function of banks. So as I conclude, so in terms of the overall risk, I use the Z-score, the log of the Z-score inverse. And then in terms of liquidity creation, I use Begg and Bowman's liquidity creation matrix, which is the CAT-FAT for total liquidity creation. As you can see in the interaction term, so higher capital requirements reduces overall risk for the banking sector, but at the same time, it has a negative impact on liquidity creation. So which means in terms of policy, regulators, there's need to balance the two. In terms of financial stability, higher minimum capital requirements, but bearing in mind that it can have an adverse impact on liquidity creation. So for most central banks in Africa, financial inclusion, which is part of liquidity creation, is a big objective. I'll stop here for time constraints.
Excellent, Brenda. Thank you. 8 minutes only.
8?
Yes.
Oh, but that's nice.
Excellent. Okay. Thank you so much, Raphael, for starting us off with some DID estimations. Our next speaker is Catherine, Catherine, do you have slides as well? So which I can put them on? It's okay.
Right, thank you.
It is. It's not working.
Okay, good afternoon, everybody. My name is Catherine Tuhirirwe, and I've been a PhD student here, just about to defend. And what I'm presenting today is one of my chapters. It is a qualitative piece of work. So it's trying to understand how accountable we are as African governments when we seek credit from these countries. How are we maintaining those loans to ensure that we're tracking them and they're bringing in benefits as they should to the economy? So that's what I'm looking at today. Yeah, so essentially, as we all know in this room, Africa and China have had the relationship for many years. And currently, China is the largest bilateral lender in many of the countries in Africa. The statistics as of 2024, Africa has taken on 182 billion. And of course, we use the database that we all love from Boston University. So that's where I got that figure from. From what we see, the loans are funding a lot of projects, very crucial projects that essentially benefit the economies, but as well, it depends on how well we utilize them to benefit us as a people. So the main research problem we have is that as this relationship is evolving, there is a lot of blame on China. China being the superior partner, shall I call it superior? There is the criticism that it should do better for the recipient countries. But then on the other hand, I should also think we have governments that have evolved for many years. They should be mature enough to know what's good for their economy and what's not good, what credits will bring problems and what credits will not. So looking at exactly what our economies are doing to ensure accountability. So as we know, China gives loans that have no strings attached. They're not interested in auditing your books to know what you've done with the money. It's up to you as an economy to do what you need to do. And from what we saw from the study in 2021 by Chaofan and her colleagues, African governments have different levels of transparency in terms of what they reveal, either in terms of the credits that they get from different funders, as well as what they use those credits for. We saw in Cameroon, they have 100% transparency, but then it varies according to other governments. And in this, it's important to explain the two theories that help to explain. We have agency theory that guides in how governments represent the interests of the citizens and how they utilize the debt that they get. And from what we can see with the debt overhang problem, the debt overhang theory explains just how not well utilized some of this funding has been for our economies. And in the literature, we have good literature that shows the good relationship between the level of transparency and the borrowing costs. Some of the reasons why African governments are taking on credits with higher interest rates is because there is no comprehensive data that tells us a full picture of the borrower. And of course, once we don't have the literature, they are classed as risky borrowers. And the riskier you are, the higher the costs of borrowing. Then as well, we've had so much literature that has focused on what China is doing in Africa, and lots of literature is about that. But in terms of African countries being accountable, Phillips did a study in Ghana looking at the project in oil. This was done in 2019. So far, he's the only person that I have found who looks at the accountability on the African side. How are there systems in place to capture where the loans are going, what they're doing, what's expected out of them, and as well as in terms of enforcement. We all have local content bills now, but are they being followed up to ensure that the whoever the officials are enforcing those content laws as they're supposed to be enforced? So to understand this, I look at the frameworks that governments use to account for these different credits. And I'm looking at the period between 2000 and 2020. But to understand things better, I identify four countries, to get a good picture of it. So I use Kenya, Senegal, Uganda, and Zambia. And from what I found, each country has its own specific accountability frameworks. They'll have, of course, the usual Ministry of Finance to engineer these deliberations. They'll also have debt management offices that make sure that they're tracking this debt and, of course, making repayments as needed. Then additionally, they also have the Office of the Auditor General to go through the books of the Ministry of Finance every year to ensure that everything has gone according to plan. So as it is, we have systems that could be satisfactory to an extent, but we shall see how things develop. Then in terms of common frameworks, we have, of course, the World Bank provided frameworks. They go into these countries, collect the data with regard to what systems they have in terms of debt management. If they are, what tools are they using to collect that debt? How comprehensive is it? And as well, how does that build with the whole strategic objectives of the countries? So from what I could find, looking at the debt management performance assessment under the World Bank, looking at the management processes that these countries have, many of them have deficiencies in terms of not being able to have comprehensive systems in place to make sure that they are capturing enough data that they need to capture. And additionally, because we have a lot of digital products that are coming up and evolving in the financial space, many of the systems don't have the capability to track and create policies for these sorts of instruments. So while you find we have some embedded within the Chinese loan contracts, there are no systems in place in these countries to capture some of those items. And this becomes problematic, of course, where they've used it, it's not captured in the system. That becomes difficult for them to account for it, as well as have systems in place to repay it. Then when we look at the global partnerships for effective development, these also assess how well the public as well as the private sector work together to ensure that there is collaboration in loan management. When we look at this, we discover that in all the sample countries, the debt is well disbursed within the financial year, but the main deficiencies come where we have the legislature overseeing these loan contracts. So negotiations will begin, everything will kick off. The parliament is aware it's happening, but you find the sessions that they have to cater for these loan contracts are not enough maybe in the year, and by the time they see to it, the loan agreement has been finalized. So there's a lot of very minimal legislative overview over these loan contracts. In terms of numbers, if I have a look, for example, in Kenya, only 66%, this is in the year 2018, 66% was overviewed by legislature. In Senegal, did better at 72, Uganda is 49 and Zambia is 54. So there's a lot of other loans that are agreed and they've not been overseen by legislature. Then something else that is problematic when we come to accountability mechanisms. If you get a loan from the Western lenders, they come with a package of their own accountability mechanisms, and you're supposed to use this to account for the loans. To a smaller extent, our economies have those systems, but it's very, very few to enforce on a Western lender to say, we'll use our systems, just provide the loan. So you find there's a lot of use of lender-provided accountability mechanisms. Then again, in terms of numbers, in Kenya, in 2018 was up to 63%, Senegal was 68, Uganda was 56, and for Zambia, we have no data because these frameworks are voluntary. So in some reporting rounds, some of these countries don't partake. So in terms of data, we're still doing quite badly. So we're not able to capture the full picture in order to make sense of what the numbers are saying to these countries. Then I also had a look at debt reporting heat maps. These are looking at how transparent the debt practices are within these countries. And what I discover is over the years, some countries do put in data, other countries don't. But the major problem that has come about is for the recent loans that they've signed, especially, of course, with the recent years, many of the loan contracts that have been agreed with China, this data is not captured in real time. So like now, if you go to a country in Africa, most likely, in one of them, you'll find the last loan that's been recorded in the books will probably be like 2020, 2021. But then they've taken on several other loans. So between there and now, and 2024, we don't have the full picture of those loan contracts. So this was a problem across all the 4 sample countries and generally in Africa, really. The only country where it was better was in Zambia. But then because Zambia went through restructuring, that could explain why they had to feed the system with all the data of loans that they've taken on. But minus that, there is not comprehensive data regarding that. Then something else we have is where we have like 2 different bodies looking at the data. In some cases, you have the debt management office handling that, but then under like the Office of the Auditor General, they'll have another body that's overseeing the debt. So in some countries like Uganda, the data that the Ministry of Finance has and what the Office of the Auditor General has is not synced. So whatever they are critiquing, you find is not the full picture that's in the Ministry of Finance. Then, of course, we have the issue of the debt ceilings as well. In terms of being accountable to the citizens, many countries have taken on a lot more debt than they should take. So many of the countries, the sample countries, all of them except Senegal and Uganda were kind of near the ceiling of the regional bodies, but Uganda and Zambia, Kenya and Zambia have hit their regional body ceilings, and the IMF, 35% as well. All of them have borrowed over that threshold. So there is lack of accountability there in terms of what the economy itself can handle in terms of debt. So I'll stop there for now, but to conclude in terms of the issues that we found, legislative frameworks are not comprehensive, and as well, the legislative overview needs to be better than what it is now, as well as the data systems, data recording systems, hence why I proposed earlier to AERC if we could have a system that captures data real time in Africa. So ideally, it's a big comprehensive project that would need collaboration from all countries. So what I would probably suppose is for the governments to get together and find a system that works across and can be implemented across each of these countries to ensure that we have real data that's captured within Africa and is synced across all the recording bodies. And little by little, once we have that system, we can have an accountability framework that works across each country. Yet again, we're working in a system where We have now regional projects cutting across different countries. The easier we have systems, the quicker rather that we have systems that are synced and work well for each and every country that's within the partnership and across Africa, the better it is for all of us to grow and utilize these loans for better. Thank you.
Thank you so much, Catherine.
Thank you.
So, are we going to mind helping with that? Because I'm not sure, I'll mess it up again. So we've now had, Raphael talk about the impacts, like direct impact of policy. So the direct impact of regulation maybe on both risk and liquidity. Catherine has talked about specifically about loan contracts and gone into depth on that. So next, I'm sorry, Chaofan, not Chaofan, sorry. Chaofan will be talking about knowledge transfer, specifically from China to Africa. So we're going closer and closer to the theme of the conference, right?
Okay, thank you very much. It's a great pleasure to join the discussion today. My topic is about knowledge transfer in China-Africa relations and the transformative impacts on the African countries. It's based on fieldwork from Ethiopia and Nigeria. I specifically focus on 3 sectors, which is telecom, and that's a representative of technological intensive sector. And the second is construction sector. That's a representative of, of capital intensive sector. And lastly, the manufacturing, that's labor intensive. And I use 9 criteria to measure the knowledge transfer from Chinese to African companies, basically including new technology, product development, production process, work ethics, business proposals, success and failure stories, etc., which is adopted from international business literature, the knowledge transfer criteria from headquarters to its international subsidiaries. The major finding is that actually the high-tech sectors have a higher level of knowledge transfer than low-tech sector, manufacturing sector. So which is contrary to the expectation of flying geese model, which would expect that the manufacturing sector, that Africa have the comparative advantage in terms of labor. The manufacturing sector would bring more knowledge transfer, but actually my result shows the opposite. So why this is the case? I look into the relationship between Chinese and African companies. So for telecom sector, I focus on Huawei. For the relation between Huawei and the local companies, mainly the African company, they serve as the subcontractors for Huawei. What they do, for example, the Huawei whole contract, the big 5G or 4G network project, they will subcontract part of the work to local companies. The company will do the accessory, installation, and the commissioning for install this telecom base station. So, and at the same time, the Huawei will provide local companies with a number of training to qualify them, to teach them the technical skill to be able to do those site survey, installation, and commissioning work. And also Huawei has the test to the performance of local companies every year to be able to qualify them in terms of project delivery, in terms of technological capability. They should be qualified to pass the test of Huawei to be able to serve as their subcontractors. So there's a high motivation of Huawei to transfer knowledge to local subcontractors because there's a cooperative relationship between them. If the local companies, they are qualified, they can do the project well, Huawei can also handle more projects. They can give a subcontractor more work. And so as in construction sector, the local company, they also serve as subcontractor for Chinese construction companies. If, for example, if a Chinese company, they got a whole road project, they will subcontract part of the work like repaving, road lining to local companies. And on the construction side, there will be 1 or 2 Chinese supervisors to supervise the work of local companies and to make sure they are on project delivery. And they also have regular health environmental training for the local companies. And so there's also a cooperative relation between them, and there's a high motivation for Chinese company to transfer skills to local construction companies. However, in manufacturing sector, there is a little supply linkage in my research. I mainly focus on industrial parks in Ethiopia and Nigeria. It's expected that the industrial park will build a linkage between foreign and local companies, but actually it's not happening. So why this is the case? Especially in textile sector, most Chinese companies, they still import material from China instead of sourcing locally, because the material in China is very cheap. It's produced in large quantity, so has the scale of economy, making the price quite low. So compared to cultivating local suppliers, Chinese company prefer to import this cheap material from China. So this results in a little supply linkage between Chinese and African companies, so low level knowledge transfer. And also the trust issue also matters. There's a low level of trust between them. And also there's a reluctance of Chinese company to cultivate local company. They are fear that they will become their future potential competitor, as because there's a low threshold in the manufacturing sector. But at the same time, if we reflect the high level knowledge transfer in the telecom and construction sector, there's also limitations. In telecom sector, although this local company, they can install the equipment for Huawei, but it's very difficult for them to produce it. They can only remain in the downstream of the value chain to serve as an installer, but it's hard for them to move up in the value chain to be able to produce that equipment. So there's a limited transformative impact in the knowledge transfer. So as the construction sector, although the local company, they can do the part of the work, in terms of construction capability, they can do a whole country a whole building to build a high level building. But the problem is financial capacity. To be able to serve as the general contractor, you need to have a high cash flow to make a construction project run, to buy the material in advance. And especially for African government project, and sometimes they don't have enough funding. They cannot pay the stage payment on time. Actually, the African government, they prefer to give the infrastructure project to foreign companies, because foreign companies, they have a high financial capacity. If they cannot pay the stage payments on time, the foreign company will still work. But for local company, if they do not get payments, they will just stop the project. So basically, the financial capacity also limits the local company to move up in the value chain. So come to my conclusion briefly. There's a knowledge transfer, but it's limited to high-tech and capital-intensive sectors, where there's a cooperative relationship between Chinese and African companies. But there's a few transformative impacts because of the technological threshold and the capital threshold. This is the tension between the old and the new industrial establishment, which haven't been adequately addressed by flying geese model. Okay, thank you.
Thank you so much. That's thought-provoking, or how the Chinese companies are protecting their profit moats. Now, the next speaker, Tianyi, is going to take us further down this journey of what's been going on at the conference, which is to talk about basically the agency shifting a little bit more to the African side now, right? So the networks and the decision-making patterns for how the managers in Africa borrow and diversify the sources of their borrowing within China.
Yes.
Hi everyone, my name is Tianyi. I'm a DPhil student at University of Oxford, as well as a fellow at BU GDP Center. My background is in international political economy, as well as international relations. So my work is basically trying to do two things. First is to understand the drivers and mechanisms that shape Chinese infrastructure credit provision in Africa. And then secondly, I'm very interested in open up the black box of non-monolithic China and Africa in decision making. So this research is first motivated by one empirical puzzle, that is, why do we see Chinese creditor diversification in some African countries but not the others? For example, in Kenya and Nigeria, we're able to see that they borrowed almost exclusively from Policy Bank for infrastructure projects since early 2000 and continue to do so right now. Whereas in countries like Ghana and Zambia, they started borrowing from Policy Bank as well, but around 2010, they started to diversify towards borrowing from Chinese commercial creditors, meaning state-owned commercial banks, as well as Chinese contractors, both state-owned as well as those of private portfolio. Of course, people would ask, why should we care about this phenomenon at all? Chinese credit diversification, as I argue, carries significant public and debt management implications, as well as infrastructure governance, and of course, debt stress implication. And all these things today, I would not have time to go deeper into, but will be discussed in an upcoming ODI paper in mid-September, co-authored by me and colleague Yunan Chen. I based my research in the literature that discussed the driver and mechanisms concerning Chinese overseas lending in Africa, as well as overseas in general. And this research is a mixed method research. And today I'll be mainly talking about the qualitative part, which is based on grounded theory, comparative case studies, as well as process tracing, using semi-structured interviews through my fieldwork in Ghana, Zambia, and China, unpacking the decision-making processes of 53 infrastructure loans through 100+ interviews. I will be briefly presenting some of the theories I generated through this exercise, and is preparing me for the next stage of quantitative regression, panel data regression hypothesis testing stage. So the first empirical finding I want to discuss with you is that credit diversification can be seen as a decision-making outcomes of parallel project/loan origination processes and financial networks. And so there are specifically 2 processes and 3 stakeholder networks involved. So instead of imagining all the borrowers and lenders and all the intermediaries between one specific African countries, as well as China, discussing a connected project and how the finance is weaved through, the reality is this process concerning Policy Bank and commercial creditors are highly separated, fragmented, and uncoordinated. And then the financial networks of Exim Bank, CDB, as well as commercial creditors also differ, engaging with various sets of statal, substatal, parastatal, and non-statal stakeholders, although overlaps do exist. So what does it look like in practice? In terms of policy comparison, we're able to see policy banks follow a very structured process, actually, including project scoping, loan pre-application, and then high-level loan pledges, and then coming back to the detailed financing and project specification before committing to loan at the individual level. Whereas commercial creditors, on the other hand, they do not involve a loan pledge stage at the diplomatic events, if you read the commitments carefully. So this is the policy bank process, and this is the commercial creditor processes. A bit further on, let's look at the stakeholder engagement. We're able to see that policy banks have a more institutionalized and formal project lending processes, meaning that the stakeholders involved in this process, their roles are actually pretty consistent across different stages. And the negotiation often take place at the bureaucratic and diplomatic tables, whereas, of course, the CDB-backed loans are more engaging at the diplomatic events, whereas the Exim Bank loans, the details of them are actually negotiated at the bureaucratic offices. Hence, there are a slightly 2 variation. Whereas commercial banks have a less institutionalized and formal project lending processes with stakeholders doing various type of roles across different roles. And the negotiating tables are also less predictable. Sometimes they happen at political party level, sometimes at bureaucratic office level, and sometimes at diplomatic level at both central stage and provincial stage. However, we're able to see one common thread that is through all these processes in the works, which is for both policy banks and commercial creditors, the common role of a transnational state business alliances between the Chinese contractors and the African bureaucracies and political elites at the center of sourcing project financing. And we're able to come back to this point later. But now let's think about what does it mean. Sorry, now I want to move on to the second empirical findings I want to talk about, which is during my interview, I did specifically ask each stakeholders on this question, why did commercial creditors funded deals were not considered through policy bank lending? Mostly because policy lending tend to be more concessional and they're longer structured, much more long-term, and have a bit of leverage in terms of weaving different political influence into negotiating the deals. Is it because there are different sets of push and pull factors directing these lending, meaning that the push and pull factors pushing the policy banks are actually different from the commercial banks, deriving from the existing literature? But in fact, what we find is both policy bank and commercial creditors lending are propelled by dynamic and multiple factors with a multiple level of agencies. We're able to see stakeholders referencing geopolitical, resources, industrial and commercial logic from the Chinese side, as well as the national development goal, partisan, rent-seeking, promotion-seeking motives from the African side. And the stakeholders involved are across different levels. So the multiple agencies' priorities matters for all Chinese creditors. For an example would be a high-level engagement at time A could have led to policy bank lending at one time, but it also led to commercial bank lending in other occasions. Risk assessment also matters. An example would be Sino-Shore guarantee can both block China Development Bank's loan and as well as commercial creditors lending. And here I quote the reasons why commercial creditors funding were not considered through policy bank lending by several of the interviewees is that sourcing lending from China is an exercise of consensus building and aligning priorities among stakeholders rather than the command and control by certain dominant stakeholders. They talk about piecing the puzzle together, and then any missing pieces will make the deal fall apart. The missing pieces are very much diversified in terms of their characteristics. So it creates a lot of hassle for me to understand, okay, so where's the theory coming from? Am I going to fail this PhD? Because the reasons here are so diverse. Sometimes because the policy bank's credits were not fast enough, they're denied by, say, Zambian or Ghanaian officials linking to their electoral needs. Sometimes they reach the national quota of policy banks, or they prefer certain companies over others. Other times, it's the difficult timing of negotiation that collapse with a certain difficult timing and patches relationship between the governments. And then there are also IMF constraints and international global economic structures that creates barriers for certain lending to happen. So how do we understand this? And then connecting back with the very beginning of this puzzle of Chinese commercial credit diversification. From the networks that we were able to examine, I think credit diversification, meaning that answering this is to answer why is there a stronger momentum for developing new processes and networks around commercial creditors in Zambia and Ghana, where the policy bank networks continue to dominate these credit provision in Kenya and Nigeria. With the missing pieces empirical findings, it also helps us to understand the question credit diversification as why were there more missing pieces in the case of Zambia and Ghana, where making consensus building around policy bank less viable, but there were favoring commercial bank lending compared with Kenya and Nigeria. So here I proposed two independent variables. One is the policy stability, measuring three dimensions. One is domestic policy structure, second is bilateral policy structure, and the third is international policy structure as the first hypothesis. Here I hypothesize that high policy stability will lead to stable push and pull factors, allowing in existing transnational state business alliances to reinforce existing networks, resulting in low diversification. And the second independent variables I propose is to look at the diversity of Chinese companies in African countries by their ownership background, by their size, and by their firm specialization in host country. Here, I propose that high diversity of the Chinese companies would foster a competitive transnational state business alliances, leading to a fragmented networks, resulting in high diversification. And here, I welcome any comments in terms of how to operationalize and measure all these different dynamics. And please let me know how you think of this story, and if you believe that there are missing pieces in these stories as well. Thank you very much.
Thank you, Tianyi. First of all, I should say I have a lot of hope for the future because the average time taken was 40 minutes, 10 minutes each. So there you go. Now, the four panelists today are at different stages, slightly different stages of their journey. So before we talk about their research, I'm going to ask them one question each, just to sort of try and get in the spirit of this session. So let me just first explain the context. So Catherine is just about to defend her thesis. She's already in an academic, she's been offered an academic position. Raphael has promised to go back and work for his bank. Chaofan and Tianyi are about a year out from their job search, from their active job search. So I should say that probably a positive, successful outcome of this session would be a couple of job offers. Yeah. So now in terms of questions, maybe I'll just follow the sequence of where they are in their careers and see what they can share with us about their experience. So I'll start with Catherine first and ask Catherine, how has it been to just be on the cusp of making this transition from being a PhD student?
Okay, thank you, Chair. I must say, it's been a very, very interesting journey, very stressful sometimes. This subject becomes when I started it, it was very thorny. I think at the time it was still very difficult to talk about China-Africa relations. My interest, I think, started like in 2016. I wanted to do it for my master's dissertation. I was told it's going to be difficult to leave it alone. But my interest was still there. But when it came to PhD, I was allowed to pursue this. And I must say, for me to grow and understand the area better, I have literally, through COVID, I must have attended every seminar that happened on China-Africa. Regardless of the time it was, I was up and, getting to know the topic better. It's still a very difficult relationship to understand, but because I've been able to, first of all, attend SOAS. SOAS is a very multinational campus where you get to talk to different people. And of course, we're on the shoulders of these giants, Dr. Mrinde and Professor Mrinde, sorry, and Dr. Alexander as my main supervisors. So I've been able to bounce ideas back and forth from them, ideally what's happening on the ground, as well as how I can translate that into academia. And that has helped me to grow, not only as a student, but also as an academic and also a voice within society. And then, of course, we have conversations that take place within the Western side, but there are also conversations that take place in Africa. And most of the times, they're not exactly merged. The view that you get from here will be different from what you get from the African side. So I also try to engage with my African side to understand exactly what's happening there. And that has also helped me to grow and also grow my network and be able to kind of hone myself into the field. I know the chair has mentioned I got an academic job. Yes, I like teaching. And actually, I've grown as a teacher at SOAS because they've given me the chance to explore that side of me. And I've enjoyed it. I actually used to have my lectures in here. So going forward though, because this is an area that I love and I'd love to see Africa grow in that area, I would still position myself as a third person waiting for a job. So I would love to work on projects in Africa that help to propel us into better growth than we currently have, especially in terms of optimizing the credit lines that we get. So if there is anybody looking for support in that area, I'm one of those. So I'll stop here. Thank you very much.
Excellent, Catherine. Thank you. And so this actually reminds me of the fact that we can see that the Voices of Tomorrow panel could be filled with researchers who focused on such a specific topic. And that's quite promising as well. And also, I mean, Catherine has done a great job of building her brand, which is what I was going to ask her next. But so we'll move on to Raphael then. And if I can ask you, Raphael, because your research is so specific, policy oriented, and regulation oriented. What are the challenges you face as having come from a bank into an academic role and then going back to a bank, of translating your academic research into crisp policy messages?
Okay, thank you. Thank you so much, Dr. Oberoi. Firstly, I come from mainstream, banking supervision, so which is largely operational in nature. And out of those operations, we come up with a lot of policies that we hope would, influence the outcomes that we seek. And from my experience, I spent about, before moving to the UK in 2021, November, for my PhD full-time, I'd spent, I think, about 18 years on my desk as a senior banking supervisor. And I was part of the bigger, African group. So Zambia, like many other African countries, firstly, we have the Association of the African, governors. And then under that, there are structures that focus on financial stability, monetary policy, on supervision. And then within the different regions of Africa, we also have the economic blocks. And Zambia belongs to, for example, the Southern Africa, SADC, and then also COMESA, which includes East Africa and, Egypt. So it's a bigger group. So my experience has been whenever, for example, Basel pronouncements are out. So we sit in a room like this and decide, guys, there's Basel III. We need, to be seen to be, part of this, global environment. There's no evidence, specific evidence, based in terms of why we want, to implement these Basel policies. I know, for example, there are some academics that have done quite a lot of work, like Torsten Beck, I believe it should be at Florence. And then there's also Professor Jones, I think at Oxford. So she's done a lot of, work in terms of, Basel implementation in Africa and how ineffective, it's been. So, and that's how we make, decisions. So to find, policy relevant evidence on Africa, you struggle. There are many reasons. So one of the reasons is data. And it explains why maybe 70% of the research on banking regulation is based on the US data, followed by European data, because data is available. Most of the banks are listed. So if I struggle, I go into Bloomberg to find listed banks in Africa, it's a handful. So most of the data is prudential. So I benefited because of my network association with the central bank to use this prudential data, which is quite, rich in terms of the variables that I'm trying to look at. And then the academic rigor has helped me to take, a step back and reflect. And through extensive literature, review, to look at things differently, more in terms of, focusing more on the outcomes and not necessarily on what, for example, the people at Basel, say. Basel, it's a specific committee and they've got interests. And to say the truth, like Africa, most of us, we are on our own. Basel agrees they've got broader interests, so which might not necessarily be in our interest as individual countries. African countries are struggling in terms of, volatility in the economies. My country is part of the sub-Saharan African countries that are commodity dependent. So each time there are movements, there's volatility in the exchange rate, which impacts the bank's balance sheets immediately. So even to set up minimum capital requirements becomes challenging. So you'll find, if I give you an example, let's say between 2012, when in Zambia the capital requirements were raised, the dollar to our local currency kwacha was 1 to 5. So yeah, 10 years later, it's about 25 to 1 to 25. So you can imagine the capital requirements, which were equivalent to $100 million in 2012, by 2022, you divide that by 25. It was just about $20 million. So you find we struggled due to this volatility. So it was one of the motivation in terms of how do we come up with policies that properly reflect the challenges that we are going through, but they are robust enough in terms of looking at other aspects. So, for example, I started with risk, and I ended up looking at the liquidity aspects. And so in short, I think going back, it puts me in a better position in terms of how hopefully I can advise my institution specifically, but also the bigger group like the SADC, the COMESA, and through our interaction. Yeah.
Excellent. Thank you. Thank you so much, Raphael. So I'll move to Chaofan, who's who's basically had a slightly different background, starting her research into in the journey into her business studies. She studied English and China studies originally, and so Chaofan, I think the question I have for you is, from what I understand, your career objectives are a little bit more sort of application oriented, business oriented, and so you've gone into an academic field where you didn't come from the exact same background. So maybe you could just share with us the challenges you faced in making these different transitions and pitching your research in the right spot.
Yeah, thank you very much. Yes, my background comes from English and communication, and it's I think this is a learning by doing process. And my home university is located in Suzhou Industrial Park, which is one of the top industrial park in China. So we got visiting from different industrial park stakeholders in Africa, like Lekki, Fruitdon in Nigeria, and Ethiopia Eastern Industrial Park. So we got communication from this different industrial park in Africa. So I take advantage of this location advantage to reach out to industrial park in Africa. That's how I began my Africa journey. I would say it's really exciting. And in 2019, that's my first time to Africa, Ethiopia. Basically, that's really come to a different world, I would say. It seemed like I come back to China 20 years ago. And at the same time, I see the whole huge potential that how China comes through before the reform and opening up. It can be prospect that maybe Africa will experience a similar route. So that's the reason my great interest in this topic to explore how Africa will develop. Yeah, and also I was in Africa for field work for 3 months, and lots of Chinese company basically very surprised to see me. Wow, a lady come alone to Africa, to Nigeria, and so at the same time I received lots of help from Chinese companies. I indeed learned a lot of help from Chinese company and Chinese industrial loans. And also one challenge for me is to reach out to African companies. And the Chinese company did introduce me a lot to their local partners, like Huawei and China Civil Engineering. And yeah, in terms of this really helped me build up the data access. Also, this exciting fieldwork experience teach me like how to ask for help when you are in an innocent place, and to really be clever, to be safe, and to reach out to contacts. Yeah, thank you.
Thank you. So you had this sort of China-focused, China-centric view of, because of the background which you started your research. So Tianyi, I'm going to ask you a slightly different version of the question. So you've got 2 different challenges that you've dealt with having done your research at Oxford. One, I think, is to sell the mixed methods that you're using. And second, to probably make people aware of how important your research is. So do you want to share how you've come across that?
Yeah, for sure. I think I have one answer for both questions. That is, first, my research has been motivated by how my research can contribute to a world better led, served, and governed with decolonizing voices. A very practical orientated perspective has been very much the Beloved School of Government in public policies. Hence, we understand that the policies problems are very much complicated. Not one method is needed. And to unpack different puzzles, different pieces of the puzzles, we need to use the tools that is the most relevant. I think I was very lucky enough to situate myself in a space that mixed methods was very encouraged, rather than being discouraged in other more traditional type of school, which focus more purely on theoretical building. And I think because of this strong policy hook, the story of China and Africa, like I mentioned in my own research, is it's not monolithic. It's very diverse, very complex. There are so many different angles. The fact that this is such a multidisciplinary field also proves to us that for each stakeholders, there are insights and pieces they're looking for. I did learn a lot in terms of having 1,000 faces for my own research. Specifically, I share the same experience is when I reach out to, for example, Zambian counterparts, I would try to bring out the policy implications of this research in thinking about debt management, thinking about project scoping, thinking about debt negotiation, and what are the interesting parts from this research that benefit the government. When I reach to stakeholders in Beijing, and trust me, even being a Chinese these days, talking to top officials in Beijing is very hush-hush. I was able to walk into the Minister of Foreign Affairs in Zambia with no one blocking me, surprisingly. Don't do that often, though. It's not, do come with a research letter. But if I do that in China, I think I won't be sitting here today. So I think in terms of pitching that story to the Chinese stakeholders, for me is, again, referencing what I think China in today's world, what they're seeking, what their responsibility as a rising stakeholders at a global stage, and what they need to do better, and what a lot of the problems that they're facing right now is also because of lack of policy making, of strategic thinking in advance. And I think they're also seeking some technical solutions and navigating through them. So yeah, I'm still learning, of course. There are days I cried in my own bedroom, knowing all the 10 people I reach out to has said no to me. But then there are wonderful people sometimes coming in front of me and then supporting me in this research and really see the value of this research. I think I cherish those days very deeply, and those are the days that give me momentum to keep going. Thank you.
Excellent. Thank you. So on that positive note, maybe just before I ask any further questions, I'll open it to the audience to offer some comments, ask any questions they have in mind, keep the conversation going. So we'll start right at the back, and then Richard.
So my question to Catherine is that, Catherine, in your research, did you look into the PFM reforms that had been carried out in these countries? Basically because these reforms are generally funded by the Western countries, Scandinavian countries specifically, and then they have a lot of, they're tech heavy in nature. They're more about automation. So are they deliberately not addressing the debt ceiling? Because I've also realized that debt ceiling has never been addressed properly, and that's why there's a debt overhang situation. But the dichotomy is that these reforms are funded by the West. Consultants from the West come in to, advise on these reforms, but then the debt trap is being blamed to China. So I don't understand, that's something I wanted to learn from your research. Did you ever, understood this element during your study? My second question is to I have to pronounce the name, Chaofan. Am I right? Yeah. So because I've done a similar work on subcontractor and relationship and neoliberal approach of large corporations towards managing subcontractors in developing countries. I wanted to learn from you, is there any protective measures which you realized with governments have to protect the SMEs and subcontractors from exploitation and not exploiting informal wage structures, which leads to high level of inequality even when the large international partner is coming and executing projects, but also exploiting informal like subcontractors and using informality, which leads to very lower wages and better worse life conditions and less skill development. So these are the two questions.
Thank you, Weber, for your two questions. So we'll collect two more. So next is Richard and then Dirk.
Okay. First comment, the advice to I was about to say I don't normally have a microphone when I teach in here, and then I remembered actually I do. But the first point is that the advice to Catherine, don't explore China-Africa relations, did not come from me as a supervisor.
I should have been explicit about it.
No. I was. I think it's great. I loved hearing what Raphael had to say about you questioning, and this would be something I would urge you to do, and that is be part of the growing voice that says that global standards, in inverted commas, imposed by the West don't necessarily work for Africa. And I really appreciated you saying that actually Basel III does not work that well for Zambia, and this is why. And a comment for you, Chaofan. It's great. I saw that in your presentation you were talking about culture transfer. And I saw that you did your master's at Jiaotong, and I know that you've in your English studies you've looked at cultural differences and looking at different cultural perspectives, and I would encourage you to really drill down on that, because as you know, the cultural differences between China and Africa have sometimes been controversial. And so I would encourage you to use your work to try and bridge that divide. So I don't have a question. These are encouragements.
Very helpful comments. Thank you, Richard. And so Dirk.
Thank you. Yeah, I was part of this DFID ERC Growth Research Program, which also looked at which also had a grant from with Emily Jones, which was indeed looking at the Basel the Basel arrangement and whether they were appropriate to African countries. Very interesting grant, I think. Now we're also part of one part was also on China Africa. And there were a range of research grants in that as well. And I've also listened today and yesterday to a range of presentations. And I wanted to comment on the third presentation, Chaofan, in that context. But I think it's a wider point, is that so what's really interesting is that you look at linkages, or you look at a sort of technology transfer through linkages probably, and which could happen through linkages. And you find not so many linkages at the moment, or subcontracting arrangements, for example, in the manufacturing sector. But that's the case quite a lot. If you look at the evidence more generally, not just Chinese firms, but generally, is that at the beginning, when firms locate somewhere, they may not have that many linkages, but later on, the foreign firms may have more linkages. I mean, that was the case in Singapore Islands, when they had their special economic zones and so on. But it could also be the case that it is a sector-specific thing, so that basically some sectors just are more prone to having linkages within the local economy than others. And so the wider point is more about, so what's so special about China Africa in this context? And that's for many ideas presented also in the AERC panel, I think, is China Africa. So the fact that China has an impact on African economies through linkages, so is interesting. It's important to know. But for policy implications, I think you also need to know a bit more. You need to know what is special about this relationship that is different from any relationship that you have otherwise. Okay, do you need to do anything different from what you otherwise have done because there is a Chinese firm compared to another foreign firm or compared to a domestic firm? So are these linkages different? Is the technology transfer different from the technology transfer that takes place between just two domestic firms, or between, say, an American firm that locates in that economy? And that I would be interested in, and it's just to push the research on China Africa a little bit further. It's not just whether there is an impact and trying to explain that, but also to sort of think, is it different? And do policymakers in African countries need to do anything differently when it comes to dealing with a Chinese firm compared to an American firm or a UK firm? That's just, and I don't know whether you have a particular answer to that, or whether anybody else on the panel has answers to that. But I find that question that we need to dig a bit deeper there, I think, and just do more there. Yeah.
Thank you so much. I think now we've collected some questions. Let's have some responses, and then we'll move on.
Okay.
Catherine, you want to start?
All right. So with regard to the debt ceilings of these many countries, I did discover there is a big idea with in terms of sovereignty with these countries. In some cases, and I know Europeans work well together in certain cases, and they respect each other's boundaries. What I find in Africa, we have all these monetary unions, but there is lack of respect for the respective monetary unions. Like in Kenya, for example, they put their threshold to 55. And this was decided in Parliament, knowing that it's over and above what's expected within the monetary union of 50%. So they outrightly disregarded the regulations of the monetary union. So hence why, as I go along, I keep proposing it. It doesn't do us a favor as Africa. We've noticed as we go along, it's not good enough to work as singular countries. And at the moment, not even like regional bodies are not working out as well as they should, simply because of that lack of respect. Depending on how strong the economy is, somehow they think they have better ground, which is another, I did propose for my PhD, to have kind of a framework where countries work well together. But I have pushback from people saying the higher economies will always take advantage of the smaller economies. But then I kind of think we could do like a rotational rotational membership or rotational management. So where the larger economies work with the smaller economies in order to propel those policies. There is lack of respect for each other in Africa. It's quite explicit. And I think that's where many of the main problems come from. So they do disregard them simply because maybe you're a middle income country, your other fellow members within the group are low income countries. They have no say in this matter, whether you disregard it or not. So I think that's the major thing that I see. The policies are there most of the times, even the systems are there, but just the lack of respect in terms of boundaries is a major problem.
Political will, when you say political will is a major deterrent?
There is that as well. Yes, we can't disregard that in Africa, especially. Yeah. Thank you.
Do you want to?
Thank you very much for interesting questions. Indeed, reminds me of lots of details from my fieldwork. The first about the African government's protective policy to its local company on two aspects. The first is in construction. Some construction project that's owned by African governments, they would enforce some local content, like require 30% of the construction need to be done by their local company. That's their protective policy. And the second, in the textile sector, Ethiopia government now already forbid to import raw fabric. That's the gray one, gray raw fabric. So to enforce, to forbid to import the dye already dyed, like has color fabric. So they want to enforce more dyeing and printing to dye in Ethiopia. That's also their protective policy. Yeah. And for the second question about the culture difference, yeah, I really appreciate that the very big topic that can dig deeper into that. And indeed, I found lots of Chinese companies that there's low trust with African companies because the culture difference, especially the language difference, and compared to Indian, Lebanese, and European companies which come to Africa maybe 50 years ago, the Chinese company only come in this 20 years, only surge up this 20 years. So there's a short history of interaction, which really shaped the low trust between Chinese and African companies. And also one interviewee very interesting mentioned that you saw lots of intermarriage between African and European, but it's very scarcely to saw that the Chinese-African marriage is also maybe reflected the culture barrier in there.
Smile because I just imagine the scene when you tell your parents you're marrying an African.
True, my father is here. Yeah.
The parties.
Yeah.
No, that's
Sorry, a big away from topic.
it's about cultural
Yeah.
interaction.
Yeah. So the culture lay the basic trust and understanding. And the last question about compare the different involvement in Africa. Yeah, indeed, I touch upon a bit Turkish company and the U.S. engagement. So I have an upcoming manuscript about compare the Turkish and the Chinese engagement. I found that in terms of financing, there's a major difference. For Chinese state-owned companies, financing is from Chinese central bank, CDB, Exim Bank. But for Turkish company, they have to sourcing international financing. So there's not a lot of state financing provided by Turkish state.
Please.
In terms of impact, it's the same type of firm. Is a manufacturing firm in Ethiopia, whatever, different from a Chinese firm is manufacturing in Ethiopia. In terms of impact, in terms of linkages.
Yeah, that's a very interesting topic to explore. I just have a little clue from my interview. That's one Ethiopian company that I work with US company. They told me that for US company, they just email them like what need to be done. They never saw the person, the manager in person. But for Chinese company, they would dispatch 1 or 2 supervisor on site to actually teach them how to do it. But for US company, just email them like what to be done. You just do it, and they never have a teaching process.
And which one do they prefer?
They actually prefer Chinese company. That will be more tutorial. Yeah.
Thank you. And so maybe Raphael and Tianyi, if you have any comments on the broader aspect of Dirk's question, which is what specifically should you be studying about China and Africa? Like why should that be different in some way?
Yeah, for me, having sat here and listened to presentation, one presentation after the other, and in terms of all the commitments from the Chinese officials, the Africans, our governments and so on. So there's this trade, so which we are emphasizing, and a lot of cooperation between China and Africa. Unfortunately, what I haven't seen, the influence of Chinese, banks in Africa. So, for example, Bank of China has been in Africa. Specifically, I think the Bank of China started in Zambia, like 97. So, but the role it plays, it's not a very major, role. It exists. So mainly is to help, in terms of payments between China and Africa. So I would want to see, because the relationship in terms of, impact, economic impact is significant. So we also want to see Chinese, banks competing with European banks in Africa. Okay, so you have all these major groups that have been in Zambia, for example. These banks have existed, the British banks, pre-independence, post-independence. They've been dominant. They've been doing the same things. When I read, some problems in 1970s when President Kaunda, for example, wanted to nationalize the financial system. When I read that report and when I look at what's happening, it's still the same. Nothing much has, changed. So I know they've been participating through Pan-African banks. For example, some of the big Chinese banks investing in a South African, standard group. But I would want to see, participating more just to provide the competition. We need to have a financial system which is competitive. I think that's what I think.
Thank you. Tianyi, do you want to add something?
Sure. Why specifically looking at China and Africa? I think one reason that motivated me was that a lot of the IMF program didn't work in African context. For example, public finance management, making it more efficient, transparent, not saying that they're not important, 100% believe that they're important. But I think a crucial question, not understanding what is happening between the way government interact with each other, really contributes to why these programs didn't work. In the case of my study, it shows that when it reached the stage of public finance management, all the projects are already being scoped. The baby's already in the belly. Like the companies are able to find a way to even compete in the public finance management in a very legal way and to get the tender. But the crucial problem is that the government lacks the capacity to plan their infrastructure development. A lot of time they delegate these agencies that are supposed to be of government capacity to their technical counterparts. So I think IMF or probably World Bank next stage should think about capacity buildings in the institutional level, having National Development Bank pulling up institutional personnel in terms of organizing these capacity scoping. I think those are the potential policy implications that I would give in looking at China and Africa relations. It's because I think there comes to a point where we need to recognize the relationship and engagement between China and Africa, and then also probably between BRICS, and also among the general global South countries, that just give the rights to their own in terms of this new engagement. And then think about it in terms of the way they manifest in aligning interest and why sometimes they are problematic in a way, but it can be solved. So yeah, I think that's the main motivation.
Excellent. Thank you so much. So we started about 10 minutes late. This conference cannot be accused of shortchanging the voices of tomorrow, but we are 4 minutes over 4, and the next session is supposed to be at 4. So I'm going to ask one question that was asked online, and one of you can answer that, and I think then we can do the changeover. Okay, so the question is from Eyob Esatu from Ethiopia. He's the CEO of ISD Africa. And I'm assuming he says they're very delighted to join us again. And the question is, how can African commodity volatility be adjusted to accrue development gains for African countries in the context of the huge trade imbalance between Africa and China? Does anyone want to try and answer that? Or maybe someone in the audience.
Let me have a go. Let
Yeah,
me have a
thank
go.
you.
Yes, again, going by my idea of having us working together. I know some countries are doing better in terms of their commodities within their countries. I'm struggling to remember the country. It's in West Africa, though, where they have farmers bringing in their produce for a standard price across board. In different countries, if I can cite an example of like Uganda, you find like the coffee, let's say, that comes from some of the prominent farmers will attract a different price compared to what the other farmers produce is priced at. So it's a case of starting from the ground, from like the individual country level, making sure that the produce that we have within the countries is standardized. You have the quality that you expect, the farmers are aware, and you're able to price that produce at a particular price. And once we have that established within the countries, then we're able to look at what we've got and where it's going and be able to price it for our external customers. In that manner, regardless of whether we have changes in supply or not within the country, we know exactly where the price points are. If we know it's a scarcity period, definitely the prices will go up. And if it's not, we regulate them according to what we have agreed within the borders. So ideally, we would start within the countries. We're not at the moment very great at doing that. And once we have the price points established for different periods, of course, depending on the seasons, then we're able to price ourselves. Same as with natural resources. If we think oil as well as minerals, we have different price points, yet it's kind of the same product across. So we kind of need to just work together and establish those price points. Once we do it, then we avoid the whole volatility situation. It's happening because we have different powers negotiating individually, and the better the negotiation power, the higher the price that you'll attract. And of course, that brings about volatility. Thank you.
To add, for example, if I'm a farmer, I may be able to precise something based on my agricultural products. But for minerals, I do not have the capacity to process it. So the key issue here is the value added. So you need to have the manufacturing. You need to tell African countries how to process those natural resources and then to add value. So that's the manufacture. That's why industrialization, modernization now are very popular terminologies.
Yeah. Sure.
Thank you so much, Hong. And I think it's, I'm not sure, but Ayob has raised their hand. Is that, and that's okay? All right, okay. So if we can just express our appreciation for the panel. Thank you so much. And now we move to the next session.
Chaofan.
Welcome.
Thank you so much.
Yeah,
much.
nice to meet you.
Okay.